Infrastructure was once viewed as more of a niche asset class, but today we're seeing broader adoption amongst our clients.
Over 70% of the assets that we invest in today were not investable asset classes 12 or 15 years ago.
Welcome to the Alts Report, where we explore the value of alternative investments and the trends shaping today's markets. I'm pleased to welcome Connor Teskey, CEO of Brookfield Asset Management. Today, we're discussing infrastructure, an asset class where we have seen increased adoption amongst our clients. Infrastructure assets help to form the backbone of the economy. They are essential systems that support how we live and work every day, from utilities that power our homes to data centers that help fuel the growth of artificial intelligence, and transportation networks that move goods and connect people around the world. And these are just a few examples. So Connor, thanks for being with us today. So as I mentioned in my opening, infrastructure was once viewed as more of a niche asset class, but today we're seeing broader adoption amongst our clients. What do you think has changed?
First of all, thank you for having us. Infrastructure is quickly becoming one of the largest and most excitable investment opportunities. And it's really being driven by two things. One, the opportunity set continues to expand. We've been investing in infrastructure for multiple decades. And one of the lines we like to use is over 70% of the assets that we invest in today were not investable asset classes 12 or 15 years ago. I'll give you the example. 15 years ago, we invested in toll roads and railroads. Today, we still invest in toll roads and railroads, but we also invest in telecom towers and fiber networks and data centers. 15 years ago, we invested in hydroelectric power dams. We still do that, but we also invest in solar and batteries and nuclear. So not only has the asset class grown, the benefits of investing in infrastructure have proven over the last several years to provide attributes to an investor's portfolio. They can provide stability, they're long duration, they're cash generative, and they can help protect against inflation.
There had been some emerging trends right over the past several years that are helping to drive some of this opportunity set. How do you think about what is more cyclical excitement versus kind of real durable demand?
Let's focus on the durable demand. 5 years ago, we identified three major themes in infrastructure that we thought would inform a lot of our activity over the next, let's say, 2 to 3 years. And those themes were the digitalization of absolutely everything, the world would need more energy than ever before, and the rewiring of global supply chains to focus on resiliency and production of critical goods and services closer to home. And those themes were very exciting because, quite frankly, the growth opportunities and the capital needs were so significant that they not only outstripped the capital available from governments, they also outstripped the capital available from public markets. And that created a very large and attractive opportunity set for investors in private capital. Fast forward to today, those three themes are actually more relevant today than they were 5 years ago. So we think those themes are going to run through the end of this decade and beyond.
Fair point. You think about certain trends like artificial intelligence and others, they've only been accelerating over the past several years. You had touched on sources of funds, right? It used to be either governments, utilities, even public markets. What has happened over the past few years, and why is private capital such an important source of funding today?
I think it goes to what is driving the growth in the infrastructure asset class. And perhaps, let's say, over the last 20 years, private capital has been increasing as an alternative or a substitute for government money. Historically, governments wanted to own the critical assets and provide the essential services to their population. Over the last 2 decades, the demand and desire to provide those services has only gone up. At the same time, government balance sheets have become stretched and they don't actually have the financial firepower to fund those critical assets and essential services. And that's created an opportunity for private capital to step in and invest in these critical infrastructure assets, both the existing ones and building new ones for the future. But there's also this second additional driver of growth in the asset class, which is corporates. The largest corporates around the world, which today are as large and as important as some of the major governments around the world, they want their own infrastructure. They want security over their own supply chain. They want control over their own inputs. And that's creating a second demand layer for infrastructure that, of course, is not going to be funded for governments by governments because it's not for the broader population. It's for those corporates themselves. So as the infrastructure asset class has continued to be an incredible source for capital, it's required that the private markets take an increasingly important and larger role.
So let's pivot to asset allocation and portfolio construction. So institutional investors have been large allocators to infrastructure for decades at this point. I mentioned in my opening, we've seen increased adoption from high net worth, but still relatively under allocated. How do you think access has changed over the past few years, and how do you view that going forward?
Access has changed tremendously just in terms of the products and strategies that are now increasingly available for high net worth investors. But as we think about that, institutional investors are incredibly large organizations that are well designed to portfolio manage, handle liquidity, manage downside. When we think about the asset class for the high net worth investor, it's one that can provide attractive returns, but increased downside protection, a greater stability of earnings, and potential protection against inflation. That is the investment profile of infrastructure. So it's not only as the asset class becomes increasingly available through new products and strategies that are available to high net worth, but just the increasing adoption that we've seen in the institutional segment over the last 2 decades, we're seeing in the high net worth segment just on a slightly lagged basis. And we expect both to see continued allocations to infrastructure going forward and growing allocations.
So final question, and you touched on a little bit on some of the other comments, but where do you see infrastructure fitting into a portfolio, and what role can it potentially play for long-term investors?
Infrastructures can sit right in that hybrid between your traditional public equity and your traditional public debt. It can provide you a return, but with downside protection, recurring cash generation, and potential inflation protection, those 4 points are really the hallmarks of the asset class. And what we're seeing in institutional portfolios, we very much expect to see replicated in high net worth portfolios over time, where as there is an increasing allocation to alternatives, we expect infrastructure to make a disproportionate amount of that alternative allocation, given that the characteristics of it very much match what individual investors are looking for.
And I think in today's environment, I think all of those unique return attributions are top of mind for both institutional and high net worth investors.
You're absolutely correct. And not only are they increasingly top of mind, every time there is a short-term disruption or headwind in the market, over the last 5 or 6 years, infrastructure has just proven to reinforce those attributes, whether it was through a pandemic or through rising interest rates.
Connor, that was great. Thanks again for joining us. We appreciate all of you joining us for this edition of the Alt Report. To learn more about alternative investments and our platform at Morgan Stanley, please visit morganstanley.com/alts or reach out to your Morgan Stanley financial advisor or private wealth advisor. We look forward to seeing you next time.